Our next topic is computation of gain and tax payable. So first define the CGT. CGT means capital gain tax. It is charged on gains arising on a chargeable person making chargeable disposal of chargeable assets. Here chargeable person means individual as well as company. An individual who are UK resident in the tax year in which the disposal take place are subject to capital gain tax on their gains, on their worldwide gains, while the non-UK resident is not examinable. Chargeable disposal includes sale or gift of the whole or part of the asset, exchange of asset, loss or total destruction of asset, and receipt of capital sum derived from an asset, like compensation received for damage of an asset and receipt for surrender of rights to an asset. While exempt disposal are disposal as a result of death of an individual and gift to charities. While chargeable assets include freehold land and building, goodwill, quoted and unquoted shares, and certain type of chattels. Remember, chattels are said to be tangible and movable assets. These are tangible, so that is why shares are not included in chattels. These are movables, that is why land and building will not be included under the definition of chattels. Exempt assets includes motor vehicle, main residence, cash, investment within ISA, individual saving account, qualifying corporate bonds, gilt-edged securities, NSNI certificates, foreign currency for private use, receivable, trade inventory and prize and betting winning. The pro forma to calculate the CGT for individual is, so pro forma is net chargeable gain, deduct annual exempt amount from the net chargeable gain. Remember, net chargeable gain means capital gain and deduct any capital losses on the sale of any capital asset in the current year, and you will get the net chargeable gain. After finding out net chargeable gain, deduct annual exempt amount, and if there is any capital losses brought forward, deduct these capital losses brought forward, and you will get the taxable gain. And from this taxable gain, you have to calculate the CGT liability by multiplying taxable gain with the appropriate rate. Here appropriate rate means for residential property and non-residential property rates are different. For the residential property, the basic rate is 18% and higher rate is 28%. And for non-residential properties like antique, painting, etc., land, the basic rate is 10% while the higher rate is 20%. So after calculating CGT liability, we have to deduct the payment on account on disposal of residential property, and you will get the tax payable. The payment on account on disposal of residential property is the tax that is paid on the disposal of residential property during the year. As per the requirement of HMRC, HMRC required that if any residential property is sold during the year, the tax on such property shall be deposited with HMRC within 30 days. So that amount of tax that we have already paid to HMRC would be deducted from CGT liability in order to calculate the tax payable. Now, how to compute the gain or loss? For this, we have to compare the net disposal proceed with allowable cost. And remember that if net disposal proceed is greater than allowable cost, then the difference is said to be gain, otherwise loss. Net disposal proceed can be calculated as the difference between sale proceed and selling expenses, while allowable cost is said to be the original cost of acquisition plus incidental cost of acquisition like legal fee, professional fee, etc., plus improvement, if any. So in this illustration, you can consider these things. Sergi sold an antique vase for 12,000 and a painting for 20,000. During the tax year, he incurred auctioneer's fee of 1% of the proceed. He acquired the asset for 13,000 and 7,000. First, we consider the antique vase that is sold for 12,000, but for selling that asset, Sergi has to incur the selling cost of 120. So the net disposal proceed is 11,880. The allowable cost of this particular antique vase is 13,000. As net disposal proceed is less than allowable cost, difference is said to be loss on the sale of antique vase. While in case of painting, we need to consider the sale proceed, which is 20,000, less selling expenses, 1% of auctioneer fee means 200, and you will get the amount of 19,800 as net disposal proceed. Deduct 7,000 of acquisition cost or allowable cost from this, and you will get the chargeable gain on the sale of painting, that is 12,800. Now to calculate the net chargeable gain, you have to consider that you have sold or Sergi has sold two assets during this year. On one asset he sustained a loss of 1120, and on another asset he earned a gain. So we will net off this gain and this loss, and the remaining figure is said to be net chargeable gain, and that is 11,680. This is said to be net chargeable gain. Net chargeable gain 11,680. Same is the case in the test understanding 2 and 3, pro forma, and then about annual exempt amount. This is 12,300 for the year, tax year 21-22. Remember again, AE is deducted. AEA means annual exempt amount is deducted from net chargeable gain for the tax year. If an individual's net chargeable gain after current period capital losses for the tax year are 12,300 or less, he or she is not chargeable to tax, because her or his gain would be reduced to nil due to the availability of annual exempt amount. And if the annual exempt amount is not utilized in a particular tax year, it will be vested. It cannot be carried forward, it cannot be carried back. These are rates. For residential property, the basic rate is said to be 18%, and for other properties the basic rate is 10%. While for residential property the higher rate is 28% and the higher rate for normal other gains is 20%. This is the rule. Disposal of UK residential property made on or after 6 April 20 must be reported to HMRC within 30 days of completion, along with a payment on account of relevant CGT liability. So that liability we have deducted in order to calculate the tax payable. Now in this illustration we have been given that Jane realized the following chargeable gain: 40,600 residential property and on antique table 20,000. Also they have told us that Jane has a taxable income of 28,700 in the tax year 21-22. Jane estimated the CGT due and made payment on account of 7,860. Calculate the Jane's capital gain tax liability for the tax year 21-22. So here we have to record the gain on residential property and other gain in separate columns. Residential property gain is 40,600, while other gain is on antique table, and that is 20,000. Say there is only one residential property sold during this year and one other asset which is sold during this year. So total gain is also on the sale of other capital asset 20,000 and on the sale of residential property 40,600. Now remember that if you have capital losses brought forward and if there is any an annual exempt amount, it will be deducted from the residential property. The annual exempt amount would be deducted from residential property, and if there is a capital loss brought forward, it will also be deducted from residential property. So your taxable gain would be, in case of other gain, it remains the same of 20,000. In case of residential property, it is reduced because of the annual exempt amount, and now it is 28,300. Before calculating the tax liability, we need to consider the unused basic rate band. Here in this question, we have been told that Jane's taxable income is 28,700. So we need to calculate unused basic rate band. The basic rate band is 37,700, and the taxable income of that person is 28,700. Difference of 9,000 is unused basic rate band. So while calculating the tax liability, we calculate the tax liability for other gains first, and in this regard we have identified that 9,000 of unused basic rate band is available, which causes us to calculate the tax liability at the rate of 10% on other gains for this 9,000 amount. Remaining 11,000 of gain would be taxed at 20%. So this will be 2,200. Now the gain tax on the residential property gain, and it is calculated at the rate of 28%. So 28,300 multiplied by 20%, and it is 5,660. So total tax liability would be 8,760, and out of this we have to deduct the amount of payment on account, which is 7,860, and when we deduct the payment on account from CGT, capital gain tax liability, remaining 900 of amount is for tax payable. So this is to remember that first you have to deduct the annual exempt amount, and if there is any capital losses brought forward from the residential property gain. And while calculating the tax liability, first you have to choose the other gains and calculate tax liability on these other gains. I think so a little bit calculating mistake, and that is the tax on 28,300 at the rate of 28% is 7,924. So it will be 7,924, and because of this the total tax liability would be 7,924 plus 3,100, and this is 11,024. And from this 11,024 we have to deduct the payment on account of 7,860, and the tax payable is 3,164. Right. The next tax understanding is same like that. Payment of CGT, the due date for the payment of CGT is 31st January following the tax year, which means for the tax year 21-22, the payment date is 31st January 23. Again, there is a question about the capital gain tax liability. CGT planning opportunities: delayed disposal until the following tax year. The planning opportunity available is that you may delay the disposal until the following tax year. For example, if you are going to dispose of asset in March and you think that in current year you already have enough capital gain that will be used by the annual exempt amount as well as basic rate band, so you can postpone the sale of a capital asset to the next month, April 2022. In this way, you can save some tax. You can use the annual exempt amount of next year. You may have a chance of calculating tax liability at the basic rate. And third, the most important is this: if you sold your your capital asset in March 22, your tax year will end on 5th April 22 and you have to pay tax on 31st January 23. But if you sold asset in April 22, your tax year will end on 5th April 23 and you have to pay tax on 31st January 24. So in this way, you may have a cash flow advantage. Also, selling assets in tranches, where asset can be split and sold in piecemeal like shares. Selling them in tranches in different tax year can allow you to use more than one annual exempt amount, and also it result in a lower total taxable gain.